You are listening to KeyStone's Stock Talk Show, episode 253. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at KeyStocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. It's great to be recording on a sad day in my Canucks 2024 season as they were officially eliminated yesterday. To start the show, however, I'm going to move on and hit the viewer mailbag to answer a viewer question on Lightspeed Commerce Inc., symbol LSPD on the TSX, a cloud vendor of omni-channel point-of-sale software to retail and hospitality customers. A viewer asks if the stock slide has finally been arrested with a solid 2025 growth guidance number and how the valuations look today with the stock just under $20. Aaron answers a viewer question on VinFast Auto Limited, VFS on the NASDAQ, a Vietnamese electric vehicle manufacturer. Aaron views the money-losing business through the lens of KeyStone's profitability criteria. Brett answers a viewer question on Mogo Inc., symbol MOGO on the TSX, a Canadian fintech company which offers an automated flat fee investment system under its subsidiary Mogo, as well as digital loans and mortgage services. The company also owns 13% of WonderFi, a Canadian crypto trading platform. He notes that while the company was clearly overvalued in 2021, is it a value today? Finally, Brennan answers a viewer question on Verde Agritech Limited, NPK on the TSX, an agricultural company which produces and sells fertilizers in Brazil and internationally. We have reviewed the business a number of times in the past and suggested listeners avoid the stock. Today, a viewer asks if we have changed our opinion. All right, let's get to the show. We welcome my co-host, Mr. Aaron Dunn, and the Killer Bees, Brett and Brennan. How are you guys doing? How was your weekend?
Well, Brennan's weekend was great.
Yeah.
Yours and mine not so much.
No.
Oilers dubs. Yeah. But I mean, it was fun. It was good hockey. I know even Ryan will say
it was terrible hockey for at least maybe for 2 periods. It was good hockey.
Brennan became an Oilers fan, about 3-4 weeks ago?
From the womb.
Well, after the Oilers got off to a historically terrible start, and then they started winning. Brennan jumped off their bandwagon, became a Canucks fan. Then the Oilers started winning, and then he got back on the bandwagon for the Oilers. So that's good.
I never got off the bandwagon.
And let's just say last year he became a Chiefs fan, and I think that was when Taylor Swift suddenly became a.
I'm not. I went to a Chiefs game. I am not a Chiefs fan.
Now Brennan's pre-ordering his Dallas jerseys.
Yeah.
Hedging his bets for the next.
Well, after this series, we'll see. Yeah.
But even last.
Yeah.
Well, you can go on. Yeah,
no, I was just going to say that the Oilers move on to face Dallas in the third round, and they will be summarily clubbed to death in that series. I'm sure. But we'll see. We'll see.
We're just being sore losers. That's all.
It's true.
No, but I mean, at the end of the day, like, you guys
only loser I can be.
And Demko. I mean, if you guys had Besser, and Demko, and I guess in the last game, or even just Demko throughout the whole series, I would argue that, I mean, it may have went different. I mean, Ryan's kind of smirking right now, but Seahawks played
sounds
very,
like a
very
lot
well.
of excuse making to me.
Mm-hmm.
Yeah,
but we'll
it
never
was
know.
funny too. Mm-hmm. Last night, when the Oilers were up 3-rip at the beginning of the third period, Ryan texted me and not very.
I was staying away from Ryan. I wasn't having anything to do with Ryan at that point in time.
Yeah,
there was a lot of yelling.
My thoughts were with you though.
Mm-hmm.
Yeah, and it was just interesting because he was like, "Wow, what a bad game," basically, and I was like, "Don't speak too soon," because literally like 5 seconds after he sent that text, They scored, and then
Well,
Rogers
literally, that text was to promote the Canucks to actually score. You do realize
Ryan
that? We've told the story before.
That's the
yes.
problem.
I have to be a little more negative.
Down in his psyche, there was a little bit of hope, and that's.
Well, I was watching it next to my daughter, and it's hard to be completely negative when you're watching it next to an 8-year-old. So I do blame her now. Yeah. So I'm just kidding.
Of course.
No, I watched it with my family. My dad, who had season tickets for 40 years to the Canucks, and there's a lot of pain there. So it was, we commiserated together after. And Eden my daughter is kind of joining the sad club, as they say, for the Canucks.
There's always
going forward.
There's always next year.
Anyways, moving on. There's always just jumping to another team, Brendan. That's
true. That's true.
It's true.
Pay attention to who I'm cheering for next year.
It's true. We should go through the poll. Brad has a poll for us. I believe I voted, but I cannot recall what I voted on. So.
I know what I voted on.
That sounds like you. I think I did get you to actually vote on this one last week. I was telling you to go look at it.
Wasn't it small caps, or was that last week?
Yeah, that was this one. So
yes.
He actually remembers the question for once. Surprising. But the question was, what market cap group currently has the best risk return proposition? So we had 32% at nano/micro cap, 32% again at small cap, 18% at mid cap, only 3%, which would have been one vote, at large cap, and 15% at mega cap.
So I think that there's two ways to look at this question. And I think that, I'm guessing Ryan looked at it one way, and when I answered it, I actually looked at it the other way, but both are equally as valid. And one is, when you say which group provides the best risk reward, some people might look at that, like I'm guessing that Ryan looked at it as, well, there are individual small caps within the small cap segment that offer excellent risk to reward, and I'm focusing on those as having the best in amongst all the groups. Now, you could also look at it as if every group were its own index, where do you think the best value would be for an investment, right? So if you were to not say, okay, let's look at individual small caps with great growth that are maybe underfollowed, trading at a nice valuation, you could look at it as like, well, would I rather invest in the small cap index, which includes everything or most everything that's considered a small cap, or the mega cap index, right? So I actually answered mega cap, because I do think that there are a couple companies in there that provide for what they are, for the diversification that they offer. If you're looking at this on like an index basis, that's probably where I would put my money. Now, if you look at it from the perspective of what I think how Ryan looked at it, I would probably agree with him that, within that small cap space, there's opportunity to find things that are unfollowed. But I'll let Ryan.
Yeah, I would agree. Within the small cap space, you can probably find a little better value right now and with some growth, but you really got to do your digging there. If I was just, I don't buy like the S&P 600, which some people call a small cap index, because there's a lot of crap in there, to be honest. And even if you go lower than that, there's the Russell 2000 or in those indexes. For me, I would prefer to be very selective in the companies that you're buying in there, because there's a lot of unprofitable businesses in there. Our criteria at minimum, and I think Aaron's going to look at a company today through that lens, is profitability, cash flow. And that's why, if you look at 30%, 40% of that index not even having cash flow positive, we wouldn't be anywhere near that. But yeah, can you find some individual companies there versus, the mega cap 7 that trade at lower valuations? Yes, right now, for sure. I mean, there's far more companies to look at there, obviously, as well. And the mega cap 7 or 8 or whatever you want to call it has performed tremendously well over the past several years. Certainly some companies of those 7 you want to own, some you might avoid, but there's probably way more to avoid in the Russell 2000. But are there 5 or 6 companies that I'd want to own and think can grow beyond those 7 larger cap companies over the next 5 to 10 years? Yes, right now.
The other interesting thing I'd like to point out is that mid and large cap range doesn't really have, I would say, that much interest right now, even outside this poll. I've been seeing less headlines. It's either small cap, mega cap, one of the two. There's kind of like that
the
empty
Gen
space
of the generational argument.
Exactly.
Right? Like everybody talks about like the boomers or millennials or Gen Z. whereas X is kind of just in the middle and just gets forgotten about. And I think that's kind of like the mid caps and the large caps too, right? People think small caps, people think mega caps, and what's in the middle is just kind of less interesting. But that also tells me, well, maybe that means that there's an opportunity there as well, right? If it's being ignored. Much like with the generational debate, right? The best generation is actually being
is X,
about.
Right? Yeah.
Whoa.
Yes, joking. Present company excluded, of course.
Yeah, that's true. All right, we got a busy show. We got 4 companies, I believe, to go through today. So I don't think we got anything else to really discuss on the docket other than me starting to cry about the Canucks, and that's just nobody wants to see that. Usually I just get angry, and nobody wants to see that either. So let's move on. The first company we're going to talk about today, I'm going to get into Lightspeed. We've talked about this company on the show in the past, and every time that we've looked at it, we've essentially said avoid it. Not that it's a terrible company. It just happens to trade at significantly high valuations given its underlying cash flow. Lightspeed Commerce Inc., symbol LSPD on the TSX, trades around $20. Its market cap about $3 billion, doesn't pay a yield. What does this business do? Well, let's get to it here. Essentially, this is a company that provides point of sale and e-commerce software solutions. The company provides its software solutions primarily to retail and hospitality customers, but even offers a leading golf course management software platform. I included that just for Brennan's benefit. It's a software that is used by over 160,000 mid-market customers in North America, Europe, and Australia. The viewer asks us if the slide from around $150 that actually went above that in August 2021 has finally been arrested with solid 2024 numbers and 2024 growth guidance, and how the valuations of the stock look today with it priced around $20. Now, I'll certainly take another look at Lightspeed, a stock we have reviewed here multiple times with the stock above $100. And as it slid from those ridiculous highs to its current $20 range, each time we have reiterated that until the company could actually prove it can produce a profit, the stock should be avoided. A take really that has been spot on to date. Let's start by looking at Lightspeed's year-to-date performance. If we see here, this is the stock chart year-to-date. It's down 23%. That's despite a pop after the company's announced Q4 numbers, and it's really what had the stock moving higher was its fiscal year 2025 outlook. Now, let's look at the company all-time here. This is over 5+ years. Lightspeed has had a wild ride over this time, pushing to insane valuations during the COVID tech bubble. Again, above $150 range, basically back to its original trading range on listing. Despite the silly valuations, the stock has produced nary a drop of cash flow over its history. Let's look at the growth here in the business. As we can see, tremendous growth in revenues. From back to March, the year end 2016, 39.9 million up to 1.23 billion over this past fiscal year. That's tremendous growth. Despite this growth, the company continues to produce negative cash flow and even produce losses operationally in its latest fiscal year. The near-term optimism calls for, and I'll put this in quotes, adjusted profitability in fiscal 2025, the current year, after the company trumpeted its $1.3 million US in total adjusted EBITDA for fiscal 2024. We'll take a quick look at whether the optimism is justified. Let's first look at the Q1 fiscal 2024 highlights. Total revenues, $230.2 million. That's 25% increase. Good increase there. That was driven by transaction-based revenue, which was up 40%, and subscription-based revenue was up just 7%. The net loss, however, $32.5 million or 21 cents per share. Adjusted EBITDA came in at $4.4 million versus a loss in terms of adjusted EBITDA of $4.3 million in the same period of last year. The company has a tremendously strong balance sheet, $722 million in cash. That's US, about $4.72 US per share in cash and cash equivalents. Let's look at that balance sheet in a little more detail. It's quite clean. Cash, again, that's US dollars there, and net cash, $722 million. So strong balance sheet, but it's not done through internally generated cash flow. The balance sheet also, as you can see here, over the last 3 years annually has been declining. That's because the company continues to lose money. Nevertheless, the balance sheet is a definite strength of the company. And I'm going to point out one observation, just anecdotally, that I've seen from monitoring small and mid-cap companies for decades. In certain market cycles, there are companies that kind of luck into raising almost too much capital. I saw this in the dot-com boom, recently in the cannabis boom that we saw in Canada. They lucked into raising almost too much capital, which sounds like it should never be a bad thing. But you see, the company does not operate like a good business many times when I see this. That would be a good business, would operate with an eye to really producing profits over the long term, because they have this massive cash buffer. In this case, Lightspeed had nearly at one point $1 billion in cash and no debt. And a culture can develop. I'm not saying that's what's gone on here, but I have seen this in the past. It can develop where profitability, which is hard for a growing business to achieve, is not the goal. And revenue growth, acquisitions, and other goals outside of this become the target. Because, to be honest, they're easier. And when the market finally asks the company to make some money, and it eventually always does, it can be difficult to turn the ship around and change the culture to one where expenses matter and you need to create a meaningful bottom line. That is when you get a management team, and we saw this after this current year. They trumpeted, again, that number of EBITDA figure of, that's an adjusted EBITDA figure for the full past year of 1.3 million US. That's off revenues of 909 million US. That's rather pathetic margin. Let's look at let's just look at the outlook and guidance that got the market excited for this company for its fiscal year coming out. Lightspeed, Buzz Lightyear. Now, it's Lightspeed expects meaningful expanded adjusted EBITDA profitability in the coming year, which will be growing the company's gross transaction volume, or GTV, customer base, and subscription revenues. The company also expects to continue to increase the proportion of its GTV that is processed through its payments platform. Lightspeed will continue to balance growth in both revenue and adjusted EBITDA as it scales its business. Well, I would say they haven't done that in the past. They're going to continue to try to do that going forward, to beyond the $1 billion in revenue level. The company expects subscription revenue growth to be better in the second half of the year than the first. In addition, owing to the steep climb in gross payment volume, or GPV, as a percentage of GTV that occurred in fiscal 2025. Transaction-based revenue growth is expected to be stronger in the first half of the fiscal year than the second half. As a result, the company's outlook, you can see it there, first quarter 2025 revenue of 255 to 260 million, with subscription revenue growth for the quarter consistent with the past quarter, or the quarter we just saw, Q4 2024. Adjusted EBITDA of approximately 7 million. For the full year, revenue growth of at least 20% and adjusted EBITDA of 40 million. All right, let's get to the valuations based off this and on a trailing basis. We can see here is a summary. Because there's no profitability, we use EV to revenue on a trailing 12-month basis. That's 1.8. EV to adjusted EBITDA, this is based on management's estimate and some estimates out there, about 35.5. Again, this is a forward estimate. I have a question mark there because it is based on kind of some optimistic estimates. PE doesn't exist because there is no true earnings in this company. Let's look at my conclusion here. Overall, considering where Lightspeed has been in terms of continued annual losses, Q4 2024 was a relative positive. But what gave investors more hope was the fiscal year 2025 guide, which stated that the business can grow greater than 20% organically while driving better than expected margin expansion. The company guided to adjusted EBITDA for fiscal 2025 at a minimum of $40 million versus consensus heading into this announcement of $22.7 million. So a significant beat. Again, adjusted profitability, it's moving in the right direction. I stress it's adjusted profitability, and the guidance still implies only 3.7% margin. That's still very low. In the end, celebrating a fiscal 2024 adjusted EBITDA figure of 1.3 million US off 909 million is not a great look, really, to me. The company should have been focusing on producing cash flow years ago, and its current profitability margin remains rather pathetic. The ship may finally be turning in the right direction, but it is not there yet. Even if the company reaches its optimistic analyst estimates out there, the stock trades at over 35 times EV to EBITDA, which is a premium valuation for a company that does not yet deserve the benefit of the doubt. The growth and strong balance sheet is intriguing, but we find growth with real profitability elsewhere and continue to monitor Lightspeed near term. Okay, I'm finished.
Yeah, I mean, this is one of those companies that, for a time was just highly, highly touted. Investors really excited about it during the pandemic when the share price was skyrocketing. But we'd always said, I mean, it's a company they've never been able to really validate themselves with bottom line profitability. With revenue growth, yes, certainly.
Tremendous revenue growth. It's a great success story on the revenue run, but at some point you got to make money.
You have to drop something to the bottom line. Are they able to do that? Maybe they do over the next year here, but it's still, to me, it's still a precarious situation.
Yeah, and I do believe, like I said, the balance sheet has been a bit of a crutch for this company, and I have seen it in the past. If they raised a ton of money at an opportune time, good on them for doing that. But the culture in this company, they've never been able to produce a profit. Now they're just getting towards that now, and your guidance for the year implies like a 3.7% adjusted EBITDA margin. So when will you get to actual profitability? I mean, they're turning in the right direction. That's nice to see. And again, they do have a good platform. It's confirmed by the industry, the sales that you see in the industry, but when can you turn it into actual profitability? The more you bet on companies that are losing money over time, the more you lose. So there's just been so many businesses since we've been asked about Lightspeed over the past 5 to 6 years that have had both growth in revenues, growth in cash flow and profitability, have good balance sheets, and they've done tremendously well. And Lightspeed, it's not a surprise to me until they can consistently prove profitability that their stock price has languished over the long term.
Yeah, it's, just on the golf course management system. Of course, I have to touch on that. But because it is funny, just anecdotally, I was talking to my buddy AJ, who lives in Vernon, and he actually golfs at the Rise, which is a course there. And he was raving about the fact that he can use this app to essentially be on whatever hole he wants, and he can order whatever food, and they will have it ready at the clubhouse basically when he gets to the 9th hole. When we had this conversation literally 2 days ago, I didn't realize that it was Lightspeed's product, basically, that the Rise golf course is using. But like you were saying, people like the platform. AJ, my buddy, was just raving about it. But of course, I don't know how much it would cost a golf course to run or to basically have the subscription or software per year. I'm sure it's very pricey. But according to Lightspeed, they were able to increase the Rise golf course's revenue by $190,000 in top line revenue. Again, I don't know exactly how they're doing that, but anyways, just thought I'd touch on that since I'm a golfer.
The turn of the ship, the pointing in the right direction, this finally starts to get to our attention. But again, we've been asked about this company at like $50, $100, $150, and then back at 120, 100, and down to 90. Is it finally value now at 90? Is it finally value at 75? And all the way, $50, it must be value now, 40. Well, it's almost back to where it was. And, until they start to show cash flow positive profitability going forward, the risk is too great. So you're catching a falling knife in a business that just, is a house of cards until it can produce profitability. Again, it started to point in the right direction. We'd be more interested in talking to management right now than we were at any time in the past 5-6 years.
I will say on as well. So Ryan was quoting adjusted EBITDA, which always I like to look into what they're actually adjusting out. So for fiscal 2024,
that's why I say adjusted.
Yeah,
I don't know
you got to make this very clear because they can roll some stuff into it, which is nonsense. Nothing's really unstandard here, but they had just under $74 million in share compensation in 2024. So if you're just thinking about looking forward, assuming the stock price doesn't change much, that's really the main movement when you're looking at share compensation. If you just took that out, they'd still be at an adjusted loss or an EBITDA loss at that point.
Yeah.
Of 34 million. So it's not like it's doing great, because when you're looking at share compensation, really you're just funding your employment expenses through share compensation. You could issue the shares and pay your employees cash. That's obviously you want to get your employees invested in the company, so there is an upside to it. But financially, that's what you're doing. So I would like to point out, they are really still financing their company, even in this adjusted EBITDA figure. They still, if they're able to grow 2 or 3 more years at the same rate, then without that share compensation, they would be in a positive figure. But as well, I will say, in their figure, since they do have such a large cash balance, which is about a third of their market cap, they're actually adjusting out quite a bit of a net interest income. That's the I in your EBITDA of 43 million. So they are actually taking a bit of a hit, which you won't see in many companies, where it actually gets dragged down by a figure like that.
Yeah.
But then on the flip side as well, if we see interest rates drop back down to 1-2%, that figure goes away as well.
Yeah, at least we're not seeing like an adjusted EBITDA figure and this company had 600 million in debt or something, because there are companies that we get asked all the time, even in the software space, that have 600 million in debt, and they're adjusting out that they're not even including the interest expense, really. It just makes it the companies aren't, it's a real expense for these businesses. Anyways, let's move on. I think we beat that to death. Again, it's a company now we would start to take a closer look at the business. But you'd really be, the thing is, for me, you're relying on management's guidance in a company that has never done it, right? They have never produced the profitability. So you really you have to believe in the team. And that's often, it can be, you're really just putting your faith in that, in a business that hasn't been able to do that in the past. And, you want them to get to like 20% margins, not 3.7, right? So, can they do that? If they can, then you could have a significant lift in the stock, but it's not there yet. All right, let's move on. Aaron's going to look at VinFast, correct?
Yeah.
Yeah. EV company. I think Aaron's going to look at it in kind of from the lens of how we would look at a business, because I don't believe VinFast is profitable at this point.
All right, we'll get into that here. So this is a question. This is an email from William. He sent this to us. So he's a listener. He said, I'm thinking about doubling down on VinFast Auto, VFS, as the product looks like Hyundai. Well, it's interesting. So we're happy to take a look at this company for William, VinFast Auto Limited. And so what they are is they're a Vietnamese electric vehicle manufacturer, and they went public in the US through a SPAC merger in 2023. The company manufactures electric vehicles, including sedans, SUVs, and electric buses. They began delivering their first EVs in Vietnam in 2022 and expanded later to the US market. They're also expanding to additional markets. So the symbol of the company is VFS on the NASDAQ. It's trading right now at a price of $524 and a market cap of about $12 billion. So, of course, we need to take a look at this company's products. Here's just a couple images of their vehicles, the sedan and the SUV. So they're pretty nifty looking vehicles. I would agree, they do look somewhat like a Hyundai. Certainly something that I would consider driving around. But anyways, let's get into the actual fundamentals of the business and see how it stacks up as a public company. So as Ryan said, what I'm going to do here is I'm going to look at the company through the lens of KeyStone's investment criteria. And really what we tell people a lot of the time is that we have 5 main criteria that we look at when we're evaluating a company. And it's important that the company passes all 5 of these criteria. And that really just moves the company into the next stage of research. It doesn't necessarily conclude the research. You really have to drill down on each one of these points. But what they are is, first and foremost, we're looking for profitability from current operations. So a company that is actually making money on the bottom line. And this is incredibly important to us because it's the profitability that validates the business model. The purpose of a business is to make money, not just revenue, but actual earnings and cash flow. So we want to see that a company is able to do that. Second, we want to see that the company is a growing business. So that means growing its revenue and growing its earnings and cash flow per share. So there are companies out there that will grow earnings on an absolute basis, but on a per share basis, earnings will actually be in decline. As a shareholder, you own shares in the company. So it's that per share growth that is meaningful to you. A third, strong financial position. So what does this mean? That a company doesn't have too much debt. A lot of companies are able to accelerate growth in the short term by really expanding their balance sheet, taking on a lot of debt. That works great as long as their market is healthy. But the moment there's a downtick in demand, or as we've seen recently, an uptick in interest rates, that can be a major hindrance to the company. It can also, it can destroy a company as well. So having a strong financial position is critical. We also, number 4, we want to see that there is a clear and achievable growth strategy. So we're always looking forward on what a company is able to do. It's fine if a company has been profitable in the past, been growing in the past, but we want to know that this growth is sustainable. So how are they going to achieve this? Is this an understandable plan? Does it have a high probability of success based on our analysis? And then finally, valuation. Is the company trading at a reasonable valuation relative to its underlying fundamentals? So we're typically looking at this on a price to earnings, price to cash flow basis. We're not necessarily looking for the cheapest companies, but we also don't want to overpay. We have some price sensitivity. So it's about buying great companies at what we consider to be reasonable prices. So let's get into this. We start with criteria number 1, and this is profitability from current operations. So I went through the financial statements here. They recently reported their Q1 financial results. And they reported a gross loss of 150 million. So losing 150 million on the gross profit line, and then a net loss for the quarter of 618 million. Last year, 2023, they recorded a gross loss of 1.7 billion and net loss of 2.4. So gross loss, what is this? It's actually highly unusual to see a company reporting a gross loss, even if they are a company that loses money on the bottom line. So companies will, of course, report the revenue figure, and then there will be specific costs associated that are attached directly to the product or service that they sell. So if you're selling a product, it'll be the raw materials that go into that product. It will be any labor costs that go specifically into building that product, and then overhead in the factory as well, specifically for construction. So this doesn't include, the sales and marketing expense necessarily. It doesn't include the rent for the head office or the management team. These are just specific costs associated with the product. And typically you're going to see this be a positive figure, even for companies that have poor financials. So in this case, with a negative gross profit, what this means is that every time they generate an extra dollar of revenue, they're actually losing more money on the bottom line. So they're losing money every time they sell a product. Now, typically companies that are losing money on the bottom line, one of the ways that they want to make up for this is they're like, well, once we achieve a certain level of volume, we'll have enough revenue that will cover our fixed costs, and we'll start making money on the bottom line. But when you have a negative gross margin, as VinFast does right now, you actually make the problem worse the more revenue that you generate. Now, I didn't look into exactly why they have a negative gross profit. This may be the case that their factories are highly underutilized. So there's a lot of overhead that is being accounted for, and then this would work itself out as they got closer to capacity. So in that case, more volume may solve the problem. But what we're looking at right now is like highly unprofitable company, big gross loss, which is certainly an issue. So for criteria number 1, they get a score of 0, no profitability from current operations. Now let's look at number 2 here, growth in revenue and earnings per share. So we don't have earnings. They're generating a net loss. We don't have earnings. So right there, they're not going to get credit for that. But what does the revenue look like? So revenue growth looks pretty good. 2023 in Vietnamese currency, 28.7 million relative to 14 million in 2022. I'm not highly knowledgeable about Vietnamese currency, but this is all because this was previous to their being a public company in the U.S. All of this previous financial data is not in U.S. dollars, but we had very strong growth in 2023, about doubling revenue. But in 2022, revenue was down relative to 2021. Looking at the first quarter results, so these are in U.S. dollars, total revenues of 302 million US, representing an increase of about 270%. So very strong growth in revenue, but no growth in earnings per share because they don't have any earnings per share. So what are we going to do here? Well, I'm going to be generous here, and I'm going to give them a half point for this. I'm going to give them the half point for the revenue. I almost wasn't going to give them the half point just because we have that issue with the negative gross margin. And as they generate more revenue, I mean, the higher the revenue growth, actually, the larger the net loss. But we're gonna assume here that part of that issue again is just lack of utilization of the factories, which would potentially change as they make more sales. So they get on the board here with half a point in criteria number 2. Now, number 3, strong financial position. Do they have a healthy balance sheet? So looking at the balance sheet as of the end of the first quarter, they have cash of 123 million. They have debt of about 3 billion. This is all in US dollars. Now, typically we would look at this on like a net debt to cash flow or net debt to EBITDA basis. But again, the company does not have cash flow, does not have EBITDA. What it does have is a big cash burn. So they burnt through about almost 700 million US just in the first quarter of 2024. So I would not consider this to be a strong balance sheet. Now, if they had a big net cash balance or just, no debt, I could say that they have a strong balance sheet, even though they're not making money. But the fact that they already have debt, they're not making any money, they're actually burning through cash, they don't have a huge cash balance. So they're going to have to go back to the market to essentially just cover their expenses. That's a precarious situation. That's not what we consider to be a strong financial position. They really need to ramp up the profitability from their operations to service this debt long term. So for strong financial position, I'm giving it a 0. Clear and achievable growth strategy. So I just kind of went through the company's documentation and looked at what they're doing, what they're planning. So deliveries, vehicle deliveries for the first quarter rose 444% to 9,700 vehicles. They are launching in new markets in Southeast Asia. They're starting construction of a manufacturing facility in India. They're growing their sales network. For the first quarter in the US, they secured additional partnerships with 10 new dealers in the United States, bringing their total to 16. So significant expansion of their dealer network in the US. In March, they officially started deliveries of their C segment electric SUV to customers in Vietnam. They're also planning on expanding, doing another delivery of their VF3 model in Vietnam, as well as other models in other geographies as well. So expanding the products, expanding the geographic reach, and they have guidance for 2024 of 100,000 vehicle deliveries. Most of this to be delivered in the second half of the year. Now, they did note that the macroeconomic situation is challenging, but they still think that they're going to achieve this target. Now, if we look at where they were in Q1, less than 10,000 deliveries, and that was huge growth year over year. 100,000 deliveries for the year is substantial growth, and especially given the fact that most of this would be packed into the second half of the year. That's substantial growth, and they do have a strategy. They're benefiting from adoption of EVs. They're coming out with products. They're expanding their geographic network. I do not know about what the customer satisfaction is with the vehicle at this point. That's something, if we want to dig deeper, looking how it would compare to, like, say, Teslas or other models out there, the experience that owners have with it. Now, at this point, that's a little difficult because these are, essentially brand new entries into the market. So they're not time tested with years on the road. But anyways, I would say that this does qualify as a clear growth plan. And I think that it's achievable as well. So for this criteria, I'm actually going to give it a 1. It's back up on the scoreboard. Now, finally, reasonable valuation relative to fundamentals. Again, we would normally evaluate a company based on price to earnings or EV to EBITDA, price to cash flow, price to free cash flow. But VinFast has none of this, right? So the only thing we can really look at is revenue. Over the trailing 12 months, they've reported revenue of about $1.43 billion. If we were to look at this on a price to sales based on the market cap of $12.2 billion, that's price to sales of 8.5 times. Now, is this cheap? Well, no, I don't really consider this to be cheap. I mean, probably the best comparable we have would be Tesla. And Tesla has a price to sales of about 6 to 7 times, right? Plus, Tesla's profitable, has a much better balance sheet, much better adoption worldwide, substantially larger company. Now, you could argue that VinFast might be in a better part of their growth curve relative to Tesla. That's something that we would just basically see over time. But it's certainly, I mean, we're not looking at what I would consider to be an attractive price to sales ratio here. And then plus the fact that we can't evaluate it based on profitability, they're going to have to get a 0 for reasonable valuation. So where does this all stack up? When we add up the scores, we're giving VinFast a score of 1.5 out of 5. That is a fail by our criteria. We think that it's the company's speculative right now. Is there potential? Yes, there's potential, but there's a lot that the company has to do and a lot that the company has to prove. And let's also put this into perspective too. Pass is not 50%. Pass is 5 out of 5. Right. So that is what would be required to pass this criteria test. So it's the company's a long way from that, but we'll watch next couple quarters that come out and see if they're able to hit those targets of 100,000 deliveries for the year and start driving some profitability, at least to the gross profit line, hopefully to the bottom net earnings line.
Yeah. So I was just reading the conference call as well. So one of the questions that they got from analysts is, when is your target going to reach gross profit break even? And they say, we remain to target gross profit margin break even by 2025. And they go on to say, like, a lot of like material costs are kind of holding them back. But again, like you just said, so they're targeting gross profit margin break even by 2025. That's gross profit. Again, like, that's not bottom line.
That is gross.
So
that's gross. Yes.
Yeah.
It's just gross.
That's gross.
So,
and that's actually so. And that's by 2025. So even with 100,000 deliveries this year, they're still They're still looking at negative gross profit. So this is a company that is going to have to raise. I'm coming to the opinion that they're going to have to raise a significant amount of capital over the next couple of years through debt, through equity issues.
Exactly.
They're very far from profitability on the bottom line.
Exactly. I was also reading that in here just because, again, we expect around some CapEx between 1 billion and 1.5 billion in 2024 for those manufacturing facilities. We plan to fund this using our liquidity reserves as mentioned above, and if needed, from the new funding resources combining equity and equity linked. So, I mean, yeah, like exactly like you said, they're probably going to be doing a raise here to fund that.
Mm-hmm.
The other concern which I see here is related party transactions. Normally this isn't something which you need to worry much about, but 56% of their EVs were related parties to the company, and then 24% of their scooters were as well. So you're wondering, what is this related party? Mm-hmm. It's a taxi company that is owned by a chairman of the company. So if that company, you need to figure out that relationship as well. And that company is not public, so you can't see if their financials are doing good. So if they just fell off, there goes effectively half their EV sales at this time.
And with these related party transactions, you also want to make sure that money is actually exchanging hands.
Yeah, and that
Not
also
saying it
brings
isn't,
into the...
but, like these are things you dig deeper in. But I mean, I would say, we wouldn't even bother digging in that area at this point because there's so many other areas where it falls short.
Mm-hmm.
Yeah, I think it's a good summary. Thank you. And we're going to move on to Mogo, are we not?
Brett, Mogo.
You got it?
We will go to Mogo.
A Canadian fintech company. Interesting business, but we've talked to them a number of times. I think the first time we actually met the crew behind this was they are based here in Vancouver, I believe, and we met them down in California at a conference. So we traveled all the way down to California to talk to them. It hasn't produced the consistent profitability that we need, but Brett's going to get into it.
Yeah, so Mogo Inc., symbol Mogo or MOGO on both the NASDAQ and the TSX, is a Canadian fintech company. The company operates a stock trading app, Mogo Trade, as well as digital wealth platform. The company offers an automated flat fee investment service under a subsidiary, Mogo. In addition, the company also offers digital loans and mortgage services to consumers. As well, under the company's Carta Worldwide subsidiary, the company offers card and payment processing programs. As well, the company owns 13% or 87 million shares of WonderFi, a Canadian crypto trading platform, as it owned shares in CoinSquare before those two companies merged. The stock is currently trading at 238 Canadian, down 26% over the past year. The market cap is 58 million Canadian at this time. However, if we zoom out, it's even been quite a bit worse. We've seen it fall over 90% from its peak in early 2021. I think it's even upwards of like 97% if you bought the very tip top. So it's obviously had a quite dramatic fall in the past few years if you were buying at that time. But how is it performing now? Looking at the last quarter, Q1 2024, the member count, so that's just users effectively signed up to their various services, has increased 5% to 2.1 million. Mogo had revenue growth of 13% to 17.9 million, of which 10.7 million was subscriptions and services, and the remaining 7.2 million was from interest revenue, growing 13.2% and 12.5% respectively. So about even growth between the two segments. The company's net loan portfolio, which is what relates to that interest revenue, less losses, or the net portfolio, I should say, increased by 1.3% to 62.5 million. So the majority of the interest growth was really just due to higher interest rates. Gross loans outstanding at this time, so that's without the expected credit losses, was 76 million. Adjusted EBITDA remained flat at $1 million. Adjusted net loss fell to 4 million from a loss of 3.9 million, so nearly the same as well. Adjusted net loss really removes the impact of their equity investments, namely WonderFi, as that is a substantial investment in their company or on their balance sheet, as well as it removes the stock compensation, as well as some other non-operating expenses. The company does guide the subscription and service revenue to grow in the mid-teens for 2024, which means assuming that the interest revenue stays roughly the same, you're not really seeing much change in their loans outstanding or their net loans outstanding. If that doesn't really change, you'd be looking at high single-digit total revenue growth, unless there's interest rate changes or they grow or shrink their loan book as well. That could change it. But I would say high single digits is a good benchmark figure for the revenue growth for the year. So switching to the balance sheet, the company is unsurprisingly a net debt position, as it does operate a loan service like a bank. And this is common. You of course take money in as bank, lend it out, and that's how a bank operates, and as well as effectively every loan service in some capacity is they'll have debt on the balance sheet and hope to loan out for a higher interest rate, and there's just net interest spread. So that's not exactly unsurprising, to say the least. The company does have 11.8 million in cash with 51.3 million outstanding credit facility. That credit facility specifically relates to that loan book. So that's the offsetting liability, and then the loans which they would be issuing out or lending out is the asset for the company itself. So 76 million, 51 million, they have about 25 million in net exposure to interest rates. As well, they have 36.3 million in outstanding debentures and 2.6 million leases. So total, including that credit facility and leases and debentures, they have a net debt position of 78.4 million. The company's debentures carry a floating interest carry an interest rate of 8 to 10%, and the credit facility charges SOFR, a floating rate, at that SOFR rate plus 8%. For the last quarter, the analyzed rate for the credit facility was about 13%, which is what you expect when you're paying plus 8% on a floating rate at this time. The debentures are due in 2025, which will require either refinance or they have the options to pay in shares. So that if that was elected to be done, you would see a dilution uptick quite a lot, as they have a $58 million market cap, $36 billion in debentures. You're looking at significant dilution if they went down that route. Not saying they would, but that is obviously an option, and that would be something you would want to merely pay attention to what they decide to do. The company does, however, have significant investors in crypto-related companies, notably holding 28 million in WonderFi, the Kevin O'Leary-backed crypto exchange, which we've previously done reviews of. The total cryptocurrency-related investments, which includes like Bitcoin ETFs and some other smaller companies, is 29.6 million, which of course they could be sold to cover the outstanding either credit facility or debentures if needed. And that is obvious an option. So really solvency or liquidity is by no means really a risk, but it's just interesting how you can see if they do what they elect to do can change the company's outcome quite a bit, as right now the interest expense does create a drag on earnings, but they do have the option to liquidate the WonderFi stock, and then they could pay down the debt in some way, whether it's the debentures maturing or if they just want to pay it down. That is obviously an option there for them. The company is offering a new service, which they just announced recently, a new stock trading platform allowing for direct investing with no transaction fees, but a $15 per month fee. So Mogo is calling this Buffett mode. Great name. And it is with the goal of reducing the gamification of investing. So like Robinhood, I believe, I haven't used it myself, but I believe they even have like fireworks or confetti fall down from this on the screen of your app when you're doing certain actions. Obviously, that's quite game-like, and that's what they're saying to reduce. But I want to point out the irony here is they have this kind of Matrix-esque font, and like the green with it seems a bit gamification to me there when you're saying you're trying to remove that. But I digress with that. As well, just on a bit of an aside as well for this, is they're saying they're doing the monthly fee because that reduces their own incentive to reduce them pushing trading onto clients. But then clients have the opposite incentive because they are trading, paying a flat fee, is they can take advantage of no commission fees past that and trade more. So you have that opposite side of the spectrum, where on Robinhood, they want you to trade as much as possible and accumulate other fees. But then the users, they can do a buy and hold strategy and pay your 0% commission, and then that's good for them. So you have opposite sides that are different. So you could end up seeing people who want to gamble more buy into something like this when that's what it's trying to get rid of. But I digress with that. It's a bit more on less to do with the company and more if you are looking to use the platform itself. But moving to valuation, as the company doesn't have net positive income and we really have to just rely on adjusted EBITDA, the company has a trailing EV to adjusted EBITDA of 17.8 times, which is not cheap for a fintech company at this time, and given their expected growth. But really putting it all together, the company is expensive given its current debt levels, although it is manageable given they do have the option to liquidate their investments if needed. It's a liquid market, it's a publicly traded company. They would probably take a bit of haircut because they do own 13%. So they obviously would drive the market down unless they could find a big block trade, which is always an option for these types of companies. But the company is just not near GAAP or even adjusted profitability at the sign. Even when discounting the financing aspect of the credit line, the debentures, they do create an overhang that will pull down the earnings with interest, expenses or payments, or result in dilution down the line, depending on how they elect. I would honestly, at this time, choose for them to liquidate WonderFi. It doesn't really seem to fit with the sense of what they're trying to do. Is before they had a significant stake in CoinSquare, I think it was about 40%. So you had a significant nearly controlling stake in the company, versus now you're a minority shareholder. So I'd like to see them just clean off their balance sheet, clean down that, and then reinvest cash, pay off their debentures, or just hold the cash and expand their loan book or invest into other opportunities over just holding equity. Because I can do that as my own investment, especially when it's now a public company. If I want to own WonderFi, I can just go and do that. It doesn't make sense to me whenever you have these companies with their own operations, but then they invest an equity stake in the company, when I can do that myself, unless they're getting something else additionally from it, which I don't see that in this case. But if you do have any thoughts on that, I would like to hear them as well. As well, I would like to see where that stock trading and the wealth management really grows to. They are pushing into direct investing, which is always, even as an aside, I like to see more platforms in Canada where severely lacking competition. You can look at your bank fees and see how much you're getting screwed over compared to American competition. And so just even as a user, I would like to see that. I'd like to see it grow. But then if you are looking at Mogo as an investment, that could be lucrative, as it is really an uncompetitive space in Canada at this time. Really, the only one-to-one comparison I would say is Wealthsimple at this time for that market that they are trying to go to. So overall, the company by no means is a write-off, but it does need to really grow that bottom line to really support that current price, as it is an expensive valuation this time. So either EV needs to go, or EBITDA needs to go up, or EV or share price needs to really go down to really make it more of an attractive opportunity at this time.
Yeah, no, I agree. Again, it's just it's a story we keep harping on. The valuations are too high, and you talked about it. I agree too. The position they have in WonderFi, I'd rather they just run the business, pay down some of the debt, and produce a profit that can grow over the long term. I mean, it's very boring, but it'll take care of itself in terms of the share price if they can do that. Right now, again, the valuations are too high for us to be involved with Mogo.
It's interesting how they can use term it the Buffett mode. I just find that.
I was going to say that because I know a couple companies that have even used Buffett's image, and have been told to nicely. Apparently, has the nicest law firm out there. Apparently, but it says please cease and desist. Right, unless they're paying something for that, they have the image there, and they have the name. Maybe they are. We haven't looked into that, right?
That's live on their website. I think in a couple places they do put in quotations, as well as they have a ton of quotes from Charlie Munger as well, Buffett, a few other value-based investors, which we're going to, that's the same philosophy we obviously have here, but it's just a bit weird when they're advertising in this sense as well.
Yeah, it's different. And maybe at some point, it probably takes a while. Everybody's using Buffett's name half the time, but if you've got the image up there and you've got the name, you're calling it that. Perhaps there is a licensing there, but I don't really think that Warren Buffett does a ton of that. So, and I'd be surprised, but we'll see how long that lasts or is able to be called that.
Yeah.
All right, now let's move on to Verde Agritech NPK on the TSX. Agricultural company, produces and sells fertilizer in Brazil. We've interviewed management a couple of times in the past. Have reviewed the company on the YouTube show. Talked about it to our clients too. It's a name that just has not delivered in terms of their targets, in terms of their guidance. Brennan again is going to review it. We keep getting questions on it, so he's going to review to see where they are right now, to see if they're delivering on some of their past targets.
Yeah, we had a couple. After our prediction show, we actually had someone say that Verde was going to perform very well this year. Obviously, it hasn't. And then there was another question that came in recently as well, just wanting us to update our take on it. So Verde Agritech Ltd, or NPK on the TSX, currently trading at a price of about 95 cents and has about a $39 million market cap. So as Ryan said, they're an agricultural company which produces and sells fertilizer in Brazil and internationally. And they offer their multi-nutrient potassium fertilizer under the K Forte, Bax, and Super Green Sand brand names. And it holds 100% interest in the Cerrado Verde project, which is the source of potassium silicate rock. So we have covered Verde a few times on the podcast. The first was as a dog back in April of 2023, following a decline of over 50% in 3 trading days after management cut guidance. And the second time was in September of 2023 as a Euro stock our take when it traded in the $2 range. And now that the stock is under $1, we've been asked a few more times to cover the stock. So here we go. Now, Verde's potash reserve is 5.9 billion tons of potash as approved by the Brazilian Mining Agency. And they're currently permitted to mine 2.8 million tons per year and have manufacturing capacity through its Plant 1 and Plant 2 for a combined 3 million tons per year. And Verde is also looking to expand this further with a new mine pit, which is pending permit approval, as well as an additional plant, number 3, which could provide additional production capacity of up to 10 million tons per year. Now, as I said when I covered the stock last year on March 30th, 2023, Verde lowered its fiscal 2023 guidance from 2 million tons of fertilizer sold to a range of 800,000 to 1.2 million. And as I said at that time, the company appears to be behind the low end of their revised guidance. And as such, they only sold 428,000 tons in fiscal year 2023 and produced a loss of 11 cents per share, while they were guiding towards EPS in the range of 4 cents to 29 cents per share. So quite a miss here. Now, looking at their Q1 2024 results, the company's tons sold were down to 85,000 with total revenue of 5.1 million, which was down about 54%. EBITDA was actually a loss of 700,000 compared to a gain of 2 million in Q1 of 2023. And net profit was also down substantially to a loss of 4.75 million or 9 cents per share. And of course, the primary reason for the decline in sales was both the decline in tons sold and the price of potassium chloride, which was down from about $500 US per metric ton to approximately where it is right now at about $300 US per metric ton. Now, quickly looking at the balance sheet, as of March 31st, 2024, they had cash of 3.2 million with debt of 45.7 million, which provides a net debt position of 42.5 million. I will also note that in their past investor presentation from last year, they indicated that they would like to aggressively pay down their debt, and we're looking to end the 2023 year with debt of 29 million. Obviously, they didn't achieve that. And if you are watching on YouTube, this is the image that I have to the right. This is from their investor presentation. Now, they also noted in their Q1 2024 that subsequent to the end of the quarter, Verde initiated a strategic debt restructuring plan, which includes seeking specific preliminary judicial relief to obtain temporary protection against actions and foreclosures by 7 banks. This request is aimed at ensuring stability while the company renegotiates terms with its financial creditors. And as such, all loan payment obligations have been suspended since April 2024, and negotiations with the banks are progressing. Essentially, they're trying to get their rates lower, but I don't believe there has been an actual update on how that is going. Now, looking at the company's fiscal year 2024 guidance, they're looking at doing about 700,000 to 800,000 tons of potash with revenue of about 55 million to 62.9 million, EBITDA of 8.9 million to 12.2 million, and earnings coming in at a loss of 1.4 million at the bottom end to a potential gain of 500,000 at the upper end. And just as a note, they are utilizing potash prices of $295 US per ton. And they note with a 10% discount results in a final price of $265 US per ton. So to conclude, my conclusion really isn't too much different from my past summaries. The business is interesting. However, it does not meet our initial investment criteria at this time. And I think the second slide of their recent investor presentation does a good job highlighting that the business is high risk, as even they indicate that investors who are risk averse should not buy their stock. Now, in 2023, the business failed to meet its financial guidance. Now, realistically, it is extremely difficult to gauge the forward financials of a business when its operations are reliant on a volatile commodity. But regardless, they did miss quite substantially. And given our lack of confidence in the fiscal year 2024 guidance, as well as, Verde's elevated debt levels and overall lack of profitability at this time, the business just remains too speculative for us. Like, even if we put our trust in the fiscal year 2024 guidance and say that the business can, in fact, reach the midpoint of their EBITDA target, the stock would be trading at about 8 times forward EBITDA, which doesn't look too bad. But again, we'd be placing our reliance on that guidance. And as well, they would also have a forward net debt to EBITDA multiple of over 4 times, which is high in our opinion. They'd also need some CapEx as well for the additional expansion plans that they're eventually going to roll out. And as well, if we anticipate that they can achieve the high end of their net income, they would still be trading at 78 times forward earnings. Again, for us, the risk just outweighs the potential reward on the company, and we continue to monitor the business at this time, just to see how they progress in achieving their 2024 guidance.
Yeah, that is I'm just reading through. We are not good enough. You want to put that back up there? Yes. That is an interesting. That's from their presentation.
This is second page of their presentation. That is correct.
Yeah, we are not good enough for you to invest in. Yep. If you are risk-averse, just want to make a quick buck.
I know. This is why I put this up.
I would like to point
delayed growth.
Yeah, it went up 28% today. So if you wanted a quick buck, that maybe should have been the reason to actually invest in it. Yeah.
Fair enough.
Don't deal well with changes. This is. We've interviewed the CEO before in the past, and I'm just going to put it frankly, the answers that we got to questions didn't meet our criteria. So again, the company, it's not just this year they missed on guidance, as far as I understand. Correct. They have missed several times in the past. It is a difficult business to predict, but perhaps like we deal with hundreds and thousands over the last 2 decades of businesses that if they know they can't guide with any degree of certainty, they don't provide guidance because they understand they can't do it with any degree of certainty. Perhaps that should be going on here. And in this case, providing guidance when it's a history of missing. At this point, you just pull back your guidance and maybe try to deliver on the numbers internally that you've stated, and then the share price can take care of itself over the long term. But Brennan said, even based on the guidance, in our opinion, the stock trades at higher valuations at this point, even if they hit that guidance. So we'll continue to monitor Verde. Nothing against the company, just that if you pose guidance, continually miss guidance, it's hard to take the guidance that you pose for the future again seriously or with any degree of credibility. So we'll continue to watch it, continue to monitor the company, and see if the business can grow over the long term. Right now, it can't grow the profitability that to the degree that it has guided to.
Yep.
All right. And I think that is going to end our show for this week. Again, if you've got any questions, keep them coming into our Your Stock, Our Take sections. If you're watching this right now, smash that subscribe button on YouTube. If you're listening to this, wherever you consume your podcasts, then rate and review us if you're on iTunes as well. We, as I always say, only positive reviews. Again, I'd like to wish everybody out there profitable investing. Thank you.
Thanks, everyone.
Thank you.